Good day, investors. Following Vale's research, let's look into Rio Tinto, a peer competitor. So it's an Anglo-Australian miner focused on iron, aluminium, copper, and other. It's a cyclical mining business, so it's not hard to understand, and it's really much dependent on Chinese demand. Their moat is strong infrastructure and scale, although their efficiency, or at least in the cost side, is lacking against peers. They're really shareholder focused, balancing ESG with reputational goals and actual performance. I put their value around 55 per share. They have really low debt, around low 20s debt to equity. They are moderately profitable and really profitable in the up cycle. Of course, their risk is always commodity cycles, prices, and some geopolitical risks because of their asset base. Some of their mines are abroad. They are both listed in the UK and dual listed in the UK and Australia, one of the largest mining companies in the world. Commodity cycles really hit them. So usually you want to buy these companies when they are extremely cheap and everything is horrible. Their iron ore operations generate great cash flows and basically most of their returns. And business simple to understand but dependent. They are a price follower, so they want to be the lowest cost producers to really compete. You can see from the 2025 first half free cash flow per segment. Iron ore dominates. Even in today, iron ore prices around 100 per ton. It's still dominating. Aluminium coming up, which is nice, followed by copper. And then you have lithium and other minerals in the last bucket. So you can see it's clearly iron ore. And most of these commodities are mainly bought by China, especially iron ore. You can see the stock prices of these miners and the iron ore price, which is tracking on the right. You can see when iron ore prices go up, these stock prices go up with it. When iron ore price goes down, these prices go down. So it's clearly visible. You can see a bit of a change at Fortescue because they have growth. So they are actually not as much down as others from the peak. Their moat, in theory, should be cost because of their scale. So cost because of low cost operations and scale and logistics. But if you look at the numbers, you can see that their unit cost per iron ore, according to 2024 numbers, are the highest, followed by Vale, followed by BHP, and the lowest is Fortescue. And if you look at their profitability, you can see that Rio and Vale's return on investment is actually 10% over the 7 years if you average them out. So they are less profitable than others. And then you can see Vale and BHP and Fortescue higher. So you can see that profitability tracks their unit cost of iron ore. Although, for example, Fortescue is more dependent on iron ore than the others. So if iron ore prices are better, it's more of a leverage iron ore play. BHP may be the less dependent on iron ore, but overall you see that iron ore unit cost matters a lot for all of these companies. Switching costs are of course really low, so because these are undifferentiated commodities. Moat mostly lies in operational efficiency and resource quality. So it doesn't matter. It does matter if you have 65% FE content or 62% or 58%. So that's really important to have the better quality iron ore and operational efficiency. Although there are some like modes where this is like such a huge scale and such capital intensity that newcomers cannot really compete. So they kind of dominate the world. This is from their first half 2025 chart. This is how they see it. Copper and aluminium prices were tending higher. So you see these in 2025 so far. Trading long-term. Iron and lithium spot prices trading below long-term averages. And very resilient financial. Yeah. They have low debt, so they have room to leverage when they need money. And you can see lithium in 23, it was quite a rush, but it collapsed. These matter a lot, especially iron ore. So where iron ore goes, that's where the company goes. And then they have this like small hedge from aluminium and copper. Iron ore industry structure has proven more resilient than expected. This is weird because right here they show, and right here, so here they show it, and here they're actually explain it. Costs have exceeded expectations. So in 2018, this was the cost curve they saw, and this was the cost curve that is actually happened in 24. So all of these companies' projections are more optimistic usually than they are. You can see that cost curve is higher than they were expected before. Although there is approximately 40% production from the majors needs to be replaced over the next 10 years. So this is really important. That means their capex needs to match that. So we have to keep in mind there is not such a, because if you think about it, China is the major demand driver, and then you have the Chinese real estate market slowly dying since 2021 September, since Evergrande, but they say they still need to replenish their iron ores, which is good. Of course, BHP has a really good slide I haven't included here, which shows that basically population growth and urbanization is going to drive demand for these resources. So it's not that growth stopped and they just maintain. Management, generally viewed as disciplined and shareholder oriented, focusing on cost control and returns. We will see that on the remuneration debt slide. Capital allocation, focusing on dividend buybacks when commodity prices are high. As you know, I don't like when they buy back share when commodity prices are high, because usually the share price goes up. Their dividend policy is also really nice, rewarding shareholders, so it's not sit on capital. Their short-term incentive plan is EBITDA, free cash flow. EBITDA I don't really like, free cash flow I do like. EBITDA, I'm afraid that they mess with EBITDA, so I rather like to have just clearer business numbers. Some ESG, people, I consider this also ESG. And this is development, right? They have to produce new, they have that 40% depletion coming up on the global iron ore producers. And of course, reputation. So they have, given the nature of their business, you go to less developed countries and mine their resources, they have to be they have to pay extra attention to their people's cultures and reputation and ESG parts. Long-term incentive plan is just total shareholder returns versus different indexes. So this is their share of capital investment. I believe this is 11 billion, and then after 2025 their guidance is to 10-11 billion capex. And you can see that what is sustaining is this, the replacement. I would consider replacement also sustaining, because if you replace, you can sustain the production. So basically 8 billion-ish is their sustaining spending. And then you have decarbonization and growth. So they are still growing in theory. And then if you look at 22 and 23, growth was minimized. So maybe we are done with the down cycle. We'll see some numbers there. Management, how do they manage their shareholders returning cash to shareholders and their debt? So you can see that they haven't done any major buybacks since 21, 2, 3, 4, like not even any major, like nothing. These are zero numbers for buybacks. They did big buybacks in 2018, then 2019 and 2020 some. So overall, in these 3 years, they reduced their outstanding shares by 6%. Now they are focusing on more dividends. They will, if you look at their presentations, they will always talk about dividend. Like every company I covered, I think they always talk about dividends here, dividends there, but can they actually sustain? I think Rio has a nice way to sustain, because if you look at cash flows are generally covered, like look at 21 oil, iron ore prices were like 216. That was, I think, the peak or something, like 200 above was the peak, and 2021 was a really good year for iron ore producers. They made $18 billion, and most of it they just returned to shareholders, very importantly, as dividends. So they didn't do buybacks when the share price was really high. So as a long-term shareholder, I think that's a better capital, because if I get the cash, I can see that, okay, iron ore prices are really high now, I'm not gonna buy with the dividend back, I'm not gonna buy new shares, maybe I invest it elsewhere. And this is a really good way to use capital. And then you can see that from 35-ish%, They are down to lower 20s in debt to equity. So that's a really good sign that they deleverage when they have more cash flow coming back in. From a margin of safety perspective, well, I use the discounted free cash flow. I always use 10% required rate of return for every company, and then you can demand a lower price if you think the risk is higher, or you are willing to pay a higher price if you think the risk is lower. So that's where you would adjust, I think. The 10 cap, which is basically a 10% free cash flow yield for 2024, would be 36, because 24, if we go back here, it was only around $6 billion free cash flow. And the 7-year average is around 58 and a half. My discounted free cash flow uses capex. So we saw a couple of slides before that their capex is basically 11 billion for 2025 and 11 to 10, so 10 to 11 billion for the years after. That's why I use the midpoint, 10.5 billion capex. I calculated my iron ore break-even price pre-tax. So this is going to be different than what you saw on a couple of slides before. These are iron ore prices I kind of use, and these are production guidances they provide, Rio Tinto. And then you have a cash flow from operations for iron ore. And then I do the same for aluminium, copper. And since the other metals category was negative, a couple hundred million, I just completely disregard it. And using all these cash flow producing segments, I come up with a free cash flow, or here I call it owner earnings, but it's the same, free cash flow. And then I use a discount. So based on their guidance provided production, cost I calculate myself, and some price estimates of the underlying commodities, right? I come up with 55 per share. On the profitability side, let's look at their return on equity and return on investment, 10.6%. Okay, over the 7 years, it's 18 and 10. They are moderately profitable, moderately to high. So when the cycle is good, they have really nice 18% return on equity. It's decent. They have really low debt, so 21.5. So it's really low debt to equity. And over the 7 years, it's usually low. So because it's a cyclical business, commodity business, you need to be deleveraged and you need to have financial room to survive. Their cost of debt is around 5.5%, a bit higher than the 7-year average, but that's understandable given that low yield environment disappeared in the last couple of years. Their coverage ratio is really healthy, so that's like, if you cover more than 5 times, I'm fine generally. And then they are relatively liquid given they are a cyclical commodity business. Their current dividend yield, which is just, if you Google stock price for Rio Tinto, is showing 4.5%. This is basically the trading 12 months of their dividend yield. And if you annualize the first half's free cash flow, you get a 7% free cash flow yield. As I usually mention, I think about intrinsic value when I get 10%. So that's my required rate of return. So for me, this would be a more expensive company. A more expensive stock at this price. The company could be fine if it's selling for cheaper. Although I would always refer to the intrinsic value calculation, because there might be a really low free cash flow yield because you are at the bottom of the cycle and the stock is trading really low compared to their 7-year average, for example, or their discounted free cash flow. So you always want to look for commodity producers. You want to look at basically the projections you see and the 7 or 8 or 10 years average price based on cash flow, 10% cash flow return. That's what I do, and I put my value between these two. Let's call it 55. So it might indicate the cycle has more room to go down, although it's been struggling really since the peak of 2029. It's slowly coming down for iron ore prices. Maybe there is more down. Maybe China can break. Maybe here, maybe there. Yeah. And the risks are commodity prices, especially iron ore, Chinese demand, which influences commodity prices, and operational geopolitical risk. So you don't want to have mine collapses like Vale had. in 2015 and 2019, or you don't want your mine to be nationalized. Overall, summing up as a summary, I think the business is moderately predictable, right? Commodity prices can move up and down, but you have these long-term trends of urbanization, population growth, and then you can sort of figure some out, like maybe over a cycle, iron ore price, and then you can use it, but it's moderate, maybe hardly predictable would be better to put. The moat is so the moat is really strong against new entrants and small players, less so against peers, because peers are cheaper than they are, producing cheaper than they are. Leadership looks solid from their approach, disciplined, shareholder-focused, balancing ESG requirements with all of their operational goals, and they are not buying back stock when the stock price is high, when the iron ore price was high. That's a big plus for me. And their capital, so they have low debt also. That's also management's doing. So that's really good. With an intrinsic value of around 55. So if you look at the chart here, Rio Tinto currently trading around 70. I think it's worth 55. So they are over the intrinsic value, I would personally think worth, and they are not as profitable so they are not like a compounder with huge growth rates that would justify paying over my intrinsic value calculation. So if you enjoyed this video, please like and subscribe, and let me know in the comments what do you think, what companies to look at. Have a nice day, and cheers.